Howdy, ladies and gentlemen. Welcome to the Weekly Economic Update. It is Tuesday, January 17th, 2023. Hope everybody's having a fantastical day out there. Hope everybody enjoyed the federal holiday yesterday. Markets were closed, so I was not at my desk, which got to sleep in, which was nice. The wife is out of town. She's on a cruise with her family down out of Florida, so I got to sleep in till... Gosh, I think my pup woke me up about 11 o'clock and did some grocery shopping, thinking that, it's a holiday, but not everyone has the day off. I'll, run into town, do my grocery shopping because we got a bad storm coming in tonight. Going to drop probably about a foot of snow on us over the next 24 to 48 hours. So, anyways, but it was packed. It was crazy at the grocery store. It was like, sometimes I'll go there I usually go during the day, and I usually try to do it in early afternoon. But sometimes you get a lot of the blue hairs in there, a lot of old people. But yesterday it was just crazy. I mean, parking lot was full, and it's a pretty ginormous store. The little town that I shop in called Castle Rock. It doesn't have a lot of choices. I mean, you got Safeway, you got a King Soopers, which is a Kroger store, and then a little further east, headed towards Elizabeth, you got a couple more grocery stores. But along the main drag of I-25, you really only got about two stores to pick from. The Safeway's old and cruddy. The Kroger store's been probably didn't open too much before we moved here back in 17. So it looks pretty brand new. So anyways, you didn't come here to hear about my shopping problems or anything like that. So again, if it's your first time watching, give me some big old thumbs up, likes, shares, subscribes. I would greatly appreciate it. You can even throw a comment in, something, hey, Ray, why don't you talk about XYZ or this or that? I'd be happy to talk about any subjects that anyone would like. And shout out to my father. It's his birthday today. He is 73 years old. He is a very old man, and I should probably give him a call and make sure he's not dead or anything. So anyways, and so my wife has a birthday later on this week on Thursday. She's going to be 52. So, not that I'm a young spring chicken. I'm going to be 49 in 3-4 weeks from now on the 15th of February. So, my wife was giving me crap the other day saying, gosh, how did I get so old? I'm going to be 52. And I was like, I don't know. You were 24 when I met you and I was 21. So, you're supposed to stay 24. There was nothing in the agreement where you'd get old. But anyways. All right. Well, let's go ahead and jump into the financial news. That's why you came here to listen. Didn't come here to listen to me ramble about all sorts of nonsense. Let's see here. A bit of red on the screen today. The Dow Jones was down 1.14%, closed at 33,910. S&P 500 was down 0.22%, closed at 3990. NASDAQ, lone bright spot here, was up 0.14%, closed at 11,095. Small caps were flat, down 0.08. The VIX was down today, 0.67. It's currently sitting at 1936. Canada was up 0.33, Brazil up 2.15, Mexico down 1%. And going across the Atlantic, a little more green over there. Germany up 0.35, UK down 0.12, France up 0.48, the Euro stocks up 0.42, Netherlands up 0.06, Spain up 0.22, Italy up 0.31, Switzerland down 0.3, and Portugal down 0.29. Russian exchanges were both in the red today. The MOEX down 1.26, the RTSI down 2.11. And the overnights in Asia, Japan was down. Japan was up 1.23%. Australia down 0.03. The Chinese markets mostly red. The Shanghai down 0.1. The SESE component up 0.12. China A50 down 0.47. DJ Shanghai down 0.04. Hang Seng down 0.78, and the Taiwan weighted barely up 0.04%. All right. So even with the holiday yesterday, things just didn't get off to a smooth start today. But hey, it's a new week. And again, kind of my prognostication of where I see things going this year. I think we're probably going to continue the downtrend that I was talking about on Friday. And if you want to go back and watch Friday's recording, you're welcome to do so. In the first few minutes, I go through the longer term trend that we're experiencing right now. And I personally, unless the Fed does, completely pivots, which, I know a lot of the financial journalists would like to see happen. But unless the Fed, decides, hey, we're going to slash rates back down to near zero, and we're going to do a bunch of quantitative easing, which essentially is just money printing from the Fed, and they buy up toxic assets or they buy up government bonds to fund the government. If that happens, say in, March, the market will take back off, and, it'll be on an uptrend probably for, 6 months to 12 months, could even go longer. But then again, we'll have to go back through this entire downswing again. And, usually the more the bubble gets inflated, the worse when it pops, the worse the, economic catastrophe is after the fact. So, all right, let's go ahead and read through this week's weekly economic update. The week on Wall Street, stocks rallied last week thanks to fresh confirmation of inflation's cooling trend and growing optimism that an inflation slowdown may provide the Fed with space to ease up on future rate hikes. See, there again, everyone's just hoping that they're going to slow down on their rate hikes. The Dow Jones gained 2%, while the S&P 500 advanced 2.67. NASDAQ was up 4.82, and internationals were up 3.32%. Improving sentiment. Investor sentiment came into the new year weighed down by recession fears and concerns that Fed rate hikes may go higher for longer, and that was in quotes. Last week, a different narrative emerged: sustained declines in inflation, a rate hike cycle nearing an end, and a resilient economy that may avoid recession resulted in a broad-based rally. Moderating inflation was evident in the Consumer Price Index report released on Thursday, which, in combination with a strong labor report the previous Friday, gave investors confidence that the environment for stocks had improved. Stocks extended their gains to end the week as a few money center banks kicked off a new earnings season with upbeat reports. Inflation's cooling trend. December CPI report showed a 0.1% decline in prices from November and a 6.5% increase from a year ago. Again, people are jumping up and down and, over only going up 6.5% from December of a year ago. But again, I guess these people are just looking for victories or, trying to steer the narrative. Core prices, excluding food and energy, slowed to 5.7%, a decline from the previous month's 6% year-over-year rise. For the last 3 months, core prices have risen at an annualized rate of 3.1%, the slowest pace in over a year. Falling gasoline prices, down 9.4%, accounted for most of the monthly decline in the CPI. Used car prices, down 2.5%, were another bright spot. The week ahead in economic data, Wednesday, we have the Producer Price Index, which is my preferred gauge of inflation, retail sales, and industrial production. Thursday, we have housing starts and jobs claims, and Friday, we have existing home sales. Companies reporting earnings this week. Today, we have Goldman Sachs, Morgan Stanley, Charles Schwab. Wednesday, we have United Airlines, the PNC Financial Services Group, and Prologis. Thursday is Netflix and Procter & Gamble. Friday is Schlumberger and PPG Industries. All right, so we'll see how the earnings come out this week, and curious to see how the Producer Price Index shapes up tomorrow, but we shall see what happens. All right, let's read through today's market recap. S&P 500 struggles for direction on Goldman Sachs-led slide. The S&P 500 struggled for direction on Tuesday after a Goldman Sachs-led wobble in financials after the Wall Street bank giant reported quarterly results that fell short of estimates. Goldman Sachs fell more than 6% after its fourth quarter results missed estimates amid rising costs, weakness in the consumer banking business, and a 48% slump in the investment banking revenues. Morgan Stanley, however, rallied more than 6% after delivering better than expected fourth quarter results as a record revenue in its wealth management business offset weakness in investment banking amid lower deal-making activity. Communication services also pressured the broader market, paced by a decline in media stocks that included Verizon, Warner Brothers, and Netflix. Ahead of Netflix's quarterly results due to Thursday, UBS said it expected the streaming giant's fourth quarter subscriber growth tracked in line with management's guide amid a quote, strong content slate and seasonality, end quote. Netflix is expected to add about 4.5 million subscribers in Q4, up from about 2.4 million in the prior quarter, but down from the 8.3 million in Q4 of last year. Snap fell nearly 3% after JMP Securities downgraded. It's probably JP Morgan Securities. JMP Securities downgraded the social media company to market perform from market outperform, citing software engagement and increased competition. Big tech was also mostly lower, with Apple the exception after the tech company announced the launch of its new MacBook Pro featuring its advanced M2 chip and a 22-hour battery. Microsoft cut gains as Guggenheim downgraded the stock to sell from neutral on worries that the company's guidance for the second quarter and the full year may fall short of Wall Street estimates. Tesla rallied 6% as Deutsche Bank in quote, strongly reiterated its buy rating on the company on expectations that the recent price cuts will likely help underpin the electric vehicle maker's volume growth. Quote, we believe this likely is a bold offensive move which secures Tesla's volume growth, puts its traditional and EV competitors in great difficulty, and showcases Tesla's considerable pricing power and cost superiority, end quote, Deutsche Bank said. Crypto-related stocks, including Riot Blockchain, Marathon Digital, were also in the ascendancy as Bitcoin added to recent gains to extend its winning streak. I think Bitcoin is up from, let me look at the chart here. Close that. Bitcoin sitting at around 21,200 at the moment. So it's rallied from about 16,000 up to 21. So that's about 25% growth in the last week. So I know a lot of the people I listen to who are not big on Bitcoin, are always calling for its demise, Peter Schiff. But, I think Bitcoin in the end will probably win out of the, in the crypto space, primarily because it's, it's the one that really can't be monkeyed with a lot. You can't increase the number of coins that are ever going to be in existence. One thing that they haven't really worked out is, what happens if, say, I have coins in a wallet on, my phone here, and I get hit by a bus. How do you extract that wealth? And I think that's the one thing they haven't really figured out is a way to hold your keys or your seed in a way that, in the event of you getting hit by a car, that you'd be able to get back to those assets. So anyway, all right, a little bit more here on the economic front. The New York Fed's Empire State Business Conditions Index, a measure of activity in the New York State, fell to negative 32.9 in January, the worst reading since the pandemic. Well, that's not good. So, all right. Like I said, some good news, some bad news. Personally, I think we're going to have more bad news on the horizon just because, when I peruse through the financial news, I see lots of job cuts, layoffs, things like that. So my expectation is that, it's going to get worse before it gets better. I know I say that quite often, but, it is what it is. All right. Next up on the slate, new retirement withdrawal rule could backfire in a costly way. A new law increasing the age you must withdraw from your retirement accounts may come with some unexpected and expensive consequences. Retirement legislation President Biden inked in December pushes the age that retirees must start taking required minimum distributions, or RMDs, from IRAs, 401ks, 403b plans to 73 this year, up from 72. That will bump up higher to age 75 in 2033. The delay allows investments to grow tax-free even longer and offers a window to sock more tax-deferred dollars away. But postponing your RMD may ultimately leave you with larger annual withdrawals later in life. Oh, darn, taking out larger withdrawals is terrible. Pushing your income into a higher tax bracket that may affect your pay in taxes for Social Security or for your Medicare premiums. It could also become a tax headache for your heirs. The more, quote, the more you push back the RMD age, the shorter the window to get all of that money out becomes, in quote, Ed Slott, a certified public accountant in New York and expert on IRAs, told Yahoo Finance. Quote, as you stuff more income into a shorter period, overall, you and your beneficiaries are going to end up paying more in taxes. RMD rules. You can't keep your funds in a retirement plan or traditional IRA, including SEP and simple IRAs, indefinitely. Eventually, they must be cashed out and taxed as ordinary income. The new rule requires that once you hit 73, you have no choice but to start pulling money out with an RMD, which is calculated by dividing your tax-deferred retirement account balance as of December 31st of the preceding year by a life expectancy factor that corresponds with your age in the IRS Uniform Lifetime Table. Very exciting stuff. There's lots of calculators out there. You can just go and take the balance from December 31st, January 1, and plug it in, put in your birth date, beneficiaries, and then boop, the report tells you how much you need to withdraw during that calendar year. And then again, what the expectations are for future years. Under the new law, account holders who fail to take an RMD face a 25% penalty on the amount not distributed, down from 50%. So that's some good news. And if you fix it fast, the penalty is lowered to 10%. Again, if you screw up, call the IRS. If you can get through to a human being, which is usually the bigger problem, you can usually get them to waive that. Tax implications. If you have other taxable income in addition to your Social Security benefits, such as your RMD, that can impact how much your benefit might be taxed. If you file a federal tax return as an individual, or your combined income, your adjusted gross income plus non-taxable interest you have earned on investments, plus 1/2 of your Social Security benefits is between $25,000 and $34,000. You may have to pay income tax on up to 50% of your benefits. If you earn more than $34,000, up to 85% of your benefits may be taxable. For those who file a joint tax return, you have a combined income between $32,000 and $44,000. You may have to pay income tax on up to 50% of your benefit. If your joint income is more than $44,000, which that's not a whole lot of money, up to 85% of your benefits may be taxable. Moreover, if you delay taking funds out, your RMD based on your dwindling life expectancy will be larger. And if tax rates should increase, you'll ultimately pay a bigger tax bill. All right, and how it affects Medicare premiums. Delaying your RMD can also have repercussions on your Medicare premiums. Premiums are based upon your modified adjusted gross income, or your MAGI. That's your total adjusted gross income plus tax exempt interest. Simply put, if you have higher income, you might wind up paying an additional premium amount for Medicare Part B and Medicare prescription drug coverage. The standard rates bump up for individuals with a MAGI above $97,000 and for married couples with a MAGI of $194,000 or more. So could cost you a little more in the long run. Anyways, so typically what most clients do, if they don't need the money today, and they got pensions and Social Security and all that other good stuff covering most of their lifestyle expenses, what I typically do is, if you have to take out, say, $20,000 out of your IRA this year, we'll take the $20,000 out, we'll deduct the taxes, and just, let's just say $4,000 for taxes out of that 20, $16,000 goes into their after-tax brokerage account. We just continue to invest it the same way we always have. It's just now in an after-tax position where they'll have to pay capital gains on any gains and losses during the taxable year that any buys and sells are made. So, it's kind of split. Some clients, they request the check. I have it mailed to them or deposited into their bank account, and they spend it however they want. Some will stick it into their savings for a rainy day. Others who it's just, it's a tax thing we have to go through, will move it out of the IRA, put it into their joint account or individual account or whatever they might have. And then, it just sits there and grows, minus whatever the taxes that were paid, over time. So, all right. So that's some little bit of tax news there. Last article here comes from our friends at First Trust, Brian Westbury, their chief economist, and it's titled Soft Landing. Let's dive in here and see what he had to say. We wrote last week about the soft landing that markets now seem to expect. If the U.S. does have a soft landing, it would be because the Federal Reserve tightened enough to slow inflation, but not enough to throw the economy into recession. Again, if you think these fools are actually going to accomplish that, I got a bridge somewhere I could sell you. In our opinion, the Fed policy should not be measured using interest rates alone. The Fed the Fed held the federal funds rate at 0% from 2008 to 2015 without inflation. During COVID, the Fed held the funds rate at 0 for just 2 years. If 7 years didn't cause inflation, how did 2 years? The answer to that question is the following: in the financial crisis, the Fed shifted into an abundant reserve monetary policy. Hang on a second. abundant reserve monetary policy and held rates at zero, but increased capital requirements and liquidity rules by enough to keep the M2 money supply in check. During COVID, the Fed expanded reserves through quantitative easing again, but relaxed its liquidity rules using banks to distribute pandemic loans and hand out unemployment checks. As a result, M2 peaked at 27% year-over-year growth in February of 21. This is why inflation accelerated right on time to prove Milton Friedman correct again. Looking at two things the Fed can control, interest rates and the growth of the money supply, there is a massive divergence. The funds rate is still below inflation. Looking at just rates, monetary policy is not yet tight. But looking at M2, money is tight. The growth rate of M2 has slowed from 27% year to year in early 2021 to 12% in January of 22 and 0% in November of 22. Given that Milton Friedman told us a slowdown in M2 growth would impact economic growth with a lag of roughly 6 to 9 months, the economy should be showing the impact. There are a few signs of slow growth, like the ISM survey showing contraction, but gold prices are surging up $260 per ounce in the past 3 months, and the jobs market hasn't weakened materially. Hold on, though. Before thinking that M2 doesn't matter, it is important to remember that pandemic policies were unprecedented. Shutting down most services and only really opening them up freely in 2022 has distorted economic data. Services were held down below trend for 2 years and are now artificially boosted, no matter what money growth does. In addition, when the Fed started its abundant reserve monetary policy, the Treasury started using its Fed checking account called the Treasury General Account, or TGA, to hoard money. For decades, the TGA had an average balance of roughly $5 billion, but lately the TGA has held hundreds of billions, and this money does not count as M2, even if it is cash held at the Fed. Taxpayers write checks from their bank accounts. If the Treasury puts those taxes in the TGA rather than spending them, they do not return to the banking system. From the end of 21 to November of 22, the TGA grew from 134 billion to 524 billion. In other words, M2 was reduced by 390 billion because the Treasury held cash out of the system. This has slowed reported M2 growth, and just maybe money isn't as tight as it appears. Another sign that money may not be as tight as it appears is that loans and leases at banks are up 12% in the year ending December, even though M2 has not grown. Nonetheless, money growth has slowed rapidly. When the money supply brakes are slammed, economic growth should suffer before inflation comes down. When this happens at the same time that distortions caused by pandemic policies come to an end, a recession seems inevitable. Our forecast for real GDP growth in this year is down 0.5%, with inflammation. That's what I have. With my arthritis. Inflation remaining above 4%. In other words, a recession with higher inflation is stagflation. That's what we expect, and that's not a soft landing. So the Fed is banking on something they probably cannot accomplish. So, all right. So that's all the news of the day. If anyone needs anything from me, please give me a buzz or go to my website, DSAFinancialGroup.com. All my contact information is there. If you need to book a meeting to get your finances on track for retirement or whatever else you want to plan for, please reach out. And if you want to shoot me an email, it's right there on the screen. You feel free to shoot me a note, and I'd be happy to get back to you. So hope everyone has a fantastical evening, and I will talk to you guys next time. Adios.